Two brothers checked their portfolios on the same morning in early 2022. David, 31, had invested $800 monthly for 3 years in popular index funds and Bitcoin. His account showed $24,100. He'd contributed $28,800. He was down $4,700. His brother Chris invested the same amount, same time frame, but in different assets their mentor had recommended. Chris's account showed $51,300. Same circumstances, opposite outcomes. David researched what made the difference and discovered 4 asset categories with remarkable crisis performance dating back a century. I'm Backer, and I analyze market patterns and historical data. Today, I'll break down these 4 asset types that historically protect wealth during economic downturns. Assets many advisors never mention because they generate minimal commissions. If this interests you, subscribe and hit like to help others find this information. Economic crashes aren't random disasters. Historical data reveals a predictable pattern I call the wealth transfer cycle. Phase 1, the collapse. Asset prices drop sharply. Stocks, real estate, commodities, everything tied to economic activity plummets. Credit freezes, panic spreads. Phase 2, capital migration. Large institutional investors must relocate capital. They can't hold only cash due to inflation. They can't stay in declining stocks, so they move into assets with 3 characteristics. 1. Tangible scarcity, cannot be created arbitrarily. 2. Essential utility, needed regardless of economic conditions. 3. Historical precedent, survived previous collapses. Phase 3, wealth transfer. While others panic sell at bottoms, informed investors accumulate these specific assets. During recovery, they've significantly increased their wealth through strategic positioning before the crisis became obvious. Let me show you the historical evidence. Major market crashes. 1929 depression, down 89%. 2008 financial crisis, down 57%. 2020 pandemic, down 34%. 2022 correction, down 19% with 9% inflation. During these same periods, 4 asset classes demonstrated remarkable resilience or growth. Asset number 1, gold mining equities. Not physical gold, the companies that extract it. Here's the performance. During the Great Depression, 1929 to 1933, major gold producers gained 400 to 500%, while the market crashed 89%. During the 2008 crisis, from March 2009 lows to September 2011 peaks, gold mining funds gained over 200%, while the market lost 57%. The mechanism is simple. When currency credibility weakens, demand for gold increases. Gold prices rise while extraction costs remain relatively stable, expanding profit margins significantly. Mining stocks provide leverage. When gold rises 50%, mining stocks often rise 150% or more. Now here's the important caveat. These stocks are highly volatile. They crashed 80% from 2011 to 2015. They're crisis positioning tools, not buy and hold forever investments. You need clear entry and exit strategies. Currently, only about 1 to 2% of investors own gold mining stocks. Financial institutions prefer keeping clients in index funds that generate ongoing management fees. Asset number 2, long-term government bonds. During the 2008 crisis, bonds returned 14.3% while stocks lost 57%. In November 2008 alone, they gained nearly 15% in 1 month during peak panic. Here's the mechanism. During crises, institutional investors, pension funds, and governments need safe parking for capital. They buy government bonds. Demand surges, bond prices rise, yields fall. Existing bondholders see capital appreciation. Critical point. You need to position before the crisis hits. Once panic starts, the gains have already occurred. You can buy directly from Treasury direct.gov or through bond funds. Now the 2022 reality check. Long-term bonds had their worst year in history, down over 30% due to inflation. Bonds hedge deflation, not inflation. This is why you need multiple asset types. Different assets protect against different crisis types. Asset number 3, farmland. According to farmland indices, U.S. farmland returned approximately 15 to 16% during the 2008 recession, while the market fell 57%. Between 2000 and 2020, farmland averaged around 11% annually with lower volatility than stocks. The mechanism makes sense. Productive farmland is finite and actually shrinking due to urbanization. Population grows. Everyone needs food. Unlike gold, farmland generates cash flow through crop yields, typically 3 to 5% annually, even if land values stagnate. Now for some historical context and balance. During the Great Depression, farmland values did decline 30 to 50% in many regions, and farm income fell dramatically. However, the land survived, transferred to stronger holders, and those who maintained productive farmland rebuilt generational wealth in following decades. Farmland isn't a crisis moonshot like mining stocks. It's a steady, income-producing store of value that tends to stabilize when financial assets collapse. For access options, you can do direct purchase, which typically requires $500,000 or more and may need accredited investor status. You can use farmland platforms, which often require accredited investor status. Or you can buy farmland REITs. These are publicly traded companies owning productive farmland, accessible for under $20 per share, paying dividends from farmer rental payments. Asset number 4, consumer staples. These are companies producing essentials: toothpaste, household products, food, beverages, items purchased regardless of economic conditions. Performance. From 2007 to 2009, the consumer staples sector fell only 28% versus 57% for the broader market and recovered much faster. Several major consumer companies posted positive returns during 2008. The mechanism: recession or depression, people still need groceries, hygiene products, and household essentials. These companies maintain stable earnings, pay dividends, have pricing power to offset inflation, and often benefit from global diversification. Realistic expectations. These stocks don't double during crises, they just decline less. Consider the math. If you're down 57%, you need a 132% gain to break even. If you're only down 28%, you need just a 39% gain to recover. Recovering faster means compounding sooner. You can buy individual companies or diversified consumer staples, funds, holding baskets of 30-plus companies. So why does this matter now? If you have retirement savings, you're likely overexposed to assets that perform poorly during crises. Standard advice: buy index funds and hold forever, works during extended bull markets. It struggles during the 18 to 24-month periods when markets crash 50% or more. Here's an example scenario. You have $150,000 in a typical 60-40 portfolio. That's 60% stocks, 40% bonds. A crisis hits. Stocks drop 50%. Your equity portion drops from $90,000 to $45,000. If it's a deflationary crisis, bonds help. If it's inflationary like 2022, bonds drop too. Your portfolio is now worth perhaps $80,000 to $90,000. You've lost $60,000 to $70,000. Meanwhile, someone positioned in these four asset types watches mining stocks surge, bonds appreciate, farmland pay dividends, and consumer staples hold steady. They're not panicking. They're accumulating discounted assets. During recovery, you're still reaching break even. They're up 60% or more from crisis lows. We're seeing elevated recession indicators right now: inverted yield curve, historic corporate debt levels, commercial real estate stress, record consumer credit card debt. I'm not predicting a crash. Predictions are unreliable, but conditions that preceded previous crashes are currently present. So what do you actually do? Strategic approach. Consider moving 10 to 20% of your portfolio into these four asset classes deliberately over coming weeks or months. Not panic moves, strategic positioning. Specific options. For gold miners, established mining funds or individual major mining companies. For bonds, long-term government bond funds or direct purchase through Treasury direct.gov with no fees. For farmland, publicly traded farmland REITs provide liquid exposure to agricultural real estate. For consumer staples, individual stable companies or diversified sector funds. Think of it like insurance. You don't buy insurance because you're certain disaster will strike. You buy it because not having it when needed is catastrophic. Here's the current opportunity. These crisis assets are currently less popular. Mining stocks have underperformed. Consumer staples have lagged technology stocks. Bond prices fell as yields rose. Historically, wealthy families position in crisis assets when they're out of favor, before the crisis becomes obvious. By the time a crisis hits headlines and dominates conversations, these assets have already repriced. The opportunity has passed. This window won't stay open indefinitely. When the next crisis becomes obvious, everyone will suddenly want these assets. Early positioners will be selling to those who waited. Now here are the key signals to monitor. Signal 1, the yield curve. When short-term rates exceed long-term rates, that's called an inversion. It has preceded every modern recession. The recession typically starts after the curve normalizes. That's when short-term rates drop below long-term rates again. Historically, recessions follow within 12 to 18 months of that normalization. Signal 2, credit spreads. This is the difference between corporate borrowing costs versus government borrowing costs. Tight spreads indicate confidence. Widening spreads signal nervousness about corporate defaults. A jump of 50 or more basis points indicates risk repricing in real time. That's your signal to accelerate defensive positioning. Signal 3, unemployment. When unemployment starts rising from cycle lows, even slightly, it often signals the recession has already begun, not that it's approaching. The response is typically late. Watch for 2 or 3 signals flashing simultaneously. That's when your crisis positioning should be complete. You don't need to act immediately or panic sell existing holdings tonight. That's not the strategy. But you need a plan because when markets move, they move rapidly. March 2020, the market dropped 34% in 23 trading days. Without a pre-existing plan, you're just reacting. Reacting leads to selling at bottoms and buying at tops. Those who navigated 2020 successfully weren't necessarily the ones who predicted the crash. They were the ones already positioned for the possibility of a crash. They had crisis assets in place. When markets cratered, they remained calm. Some were buying. Here's the framework you need to understand. The market isn't one game, it's two. The bull market game rewards growth, technology, momentum. The crisis game rewards safety, scarcity, essential demand. Most investors only know one game. They win during good times and lose it during bad times. Investors building lasting wealth know both games. They hold positions for prosperity and positions for crisis. Let me bring this back to where we started. David's mentor lived through major economic disruptions. He watched some families lose everything while others thrived. He spent years teaching these patterns. Chris listened and positioned accordingly. David didn't, until that morning showed him the cost. You're in a similar position. You've been taught one approach, given one playbook. That playbook works until it doesn't, until crisis reveals you were never taught how to protect yourself. These 4 assets aren't secrets. They're documented in historical records spanning a century. Mining performance during the Depression is public information. Bond returns during 2008 are in federal databases. Farmland indices are published quarterly. Consumer staples performance is tracked by major financial data providers. This information exists. It's just not widely promoted. The financial industry profits when clients buy and hold index funds through every crash, paying management fees while portfolios decline. They don't profit when clients own protective crisis assets. Don't interpret current stability as permanent safety. Every major crash was preceded by periods when everything seemed fine. Strategic money moves before crises become obvious, not after. Here are your action steps. First, audit your current portfolio. What percentage is in assets that surge during crashes versus assets that collapse? If it's mostly the latter, you have work to do. Second, research these 4 asset classes. You don't need to buy anything today, but educate yourself. Understand what mining stocks actually are. Review bond fund historical performance. Explore farmland platforms. Learn about consumer staples companies. Be educated so you can act decisively when needed. Third, monitor the signals. Yield curve, credit spreads, unemployment, set up alerts. Check weekly. When data shifts, you'll know. The next crisis is coming. It always does. The question is whether you'll be positioned for it. If this changed how you think about portfolio construction, if you now see there's a second playbook, share this with someone who needs it. A friend who's been following standard advice and struggling. A family member who thinks index funds are the only option. Someone who deserves to know there's another approach. This is Backer. Stay informed and strategic out there.